The following radio program is for informational purposes only and is neither specific nor tailored financial advice to any individual. It is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Always do your own due diligence and consult a financial advisor before making any investments. Investing involves risk, which can result in the loss of any or all principal. Peter Weitz is a registered investment advisor with Fusion Analytics Investment Partners, LLC, an SEC-registered investment advisor, as well as a registered rep with Fusion Analytics Securities, LLC, a FINRA registered broker-dealer and SIPC member. All views expressed in this program are those of the host or guests and do not reflect the opinions of Fusion Analytics Investment Partners nor its affiliates. Your investments. How secure are you that they are secure? Do you want to know more about investing, retirement, and moving to the next level in business? Welcome to In Black and Weitz, featuring host Peter Weitz. Our program will answer all of the questions about your future and so much more. It's all about smart business and smarter investing. Now, here is your host, Peter Weitz.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. Thank you again to Lisa Miller. Last week, we got a lot of call-ins regarding the biotech industry, and it was definitely a learning experience. This week, we're going to keep it along the same lines and continue that sort of educational conversations that we're having about the industry and the markets in general. And I'm going to be joined in just a moment by a really a great guest, and it's going to be to me, an excellent conversation because we're going to talk about how to beat the stock market. Not so much how to beat the stock market, but how to win against the stock market. And what are things you can actually do and things that experts in the industry think about to help pick the correct stocks to help you make money, regardless of whether the markets are going up or going down. Before we do, just a couple of housekeeping issues. Make sure you follow us on Twitter. At Peter Weitz is my handle. Feel free to log into the blog inblackandweitz.com. I'll be posting some statistics and some data that our guest talks about today. And as always, your emails and phone calls are more than welcome here on the show, as our guest will be happy to answer any questions that you have. But without further ado, let me introduce today's guest, Michael Needleman, who's managing partner at Fusion IQ, and he's the manager of a long-short strategy of investments. And I'm going to have him explain a little bit what that means shortly, but let me just give you a little bit on his background. He formerly was a portfolio manager at Preservation Asset Management and a portfolio manager and a partner at Ridgecrest Partners, Thomas Wiesel Partners, and he's a senior managing partner at Bear Stearns. So what does all that mean? It means that over his 25 years of experience, he's figured out a way to decide how to buy a stock, when to buy a stock, when to sell a stock, and what's a good value. And I think what you'll hear today is that his results are amazing. And the last I saw a statistic, and Michael, correct me if I'm wrong, but in the last 30 months, they've outperformed their index by over 3,000 basis points, which is amazing. So without further ado, Michael Needleman, welcome to the program.
Peter, thank you for having me on today. I definitely appreciate it. And hello to everybody.
And so real quick, you know, we talk about investing and we talk about how to decide. You know, I had one of your partners on several months ago. We talked how to pick a stock, things that you think about. And, you know, I'm looking at the mission statement of your long-short strategy, and it says produce absolute returns regardless of market conditions. And I'm wondering right out of the box if you can just tell me two things. Number one, define what a long-short strategy is, and tell me what producing absolute returns regardless of market conditions means.
Peter, in terms of a long-short strategy, it's a certain style of investing, and long-short suggests, as the name, that you can be long securities and or short securities and or indexes. Oftentimes when people look at mutual funds, it has a long bias. So you do not have the protection if the market for a prolonged period or for a short period goes down, so you don't have that short exposure. There are certain funds out there that do have short exposure in them, but it takes some investigation and investigating to find those funds. From the standpoint of what we do in terms of absolute returns, absolute means just like the term suggests. It is not relative. It is an absolute return. So what we try to find overall in our investment thesis from a portfolio aspect is in any given market, we look for absolute real returns, not relative. In relative terms means relative to a certain index, we were up or down. We look for positive returns, try to achieve positive returns in all market conditions, and that's why we try to use the term absolute versus relative.
And, I'm looking at, you obviously have investment beliefs and you have theories that you go on. And I just want to outline some of your beliefs as a framework to how you think and how you're able to pick, such favorable stocks, either on the long or short side, to create, additional wealth. The first belief is that you believe that the fundamental process is essential. And so obviously you look a lot at fundamentals. What are fundamentals?
Fundamentals are how a company progresses, or how is a company progressing. And in essence, it's almost like a report card. Public companies are required by law to each quarter give out what they've done. And what you are constantly looking at is you are looking at what they've done in sales, their top line, what they've done in earnings, what they've done in margins, what they've done in cash flows, how their margins are, whether they're going up, whether they're going down. And in addition to looking at an individual company returns on a quarterly basis, one needs to be aware of how other companies in that industry or the companies that they benchmark against, how they're progressing. It is our belief that the fundamental aspect of a company's worth is truly derived from how that company is doing. And at the end of the day, we truly measure cash flows, and we look for EBITDA, which is a term used in Wall Street, but it's earnings before depreciation, interest, and taxes. That's a term that's used on throughout Wall Street, but we really look at the cash flow of a company because we believe that cash flow is a true measure of how a business should be measured.
And then your second one is you believe in minimizing losses with tight risk management controls. And I'm guessing that that's stop losses.
Correct.
And
when we
go ahead.
Pick a security, and every security stands on its own merit, what we try to fundamentally do is it's easy to look at a name and say, oh, we think the stock can go to here, or we can kind of give it a valuation much higher. What we also try to do is we try to preserve the capital base. So when we buy a name or we go short a name, we institute what we refer to as a stop loss. And that stop loss does a couple of things. One, it somewhat takes out the emotional factor. Now, there are times that if that particular security hits that parameter, we do a number of things. One, we try to really make an observation on why it's done that. Is there news that surrounded that? Is there an opportunity that maybe because we've done a great deal of research, or we've had a meeting with the company recently, or we've talked to a number of their customers and or their supply chain, that it may be an opportunity? We may let that security kind of go through that stop loss. Having said that, there's a large percentage of the time that when it hits that stop loss, we listen to that stop loss and we sell the security. We are not opposed to coming back to names because we've done so, but it is our way of protecting losses, because oftentimes not everyone, but we all are human, we let it go, and that drop of whether it's 8%, 9%, or 10%, whatever your stop loss is, becomes a much greater loss. And when it does, just to get back to basically break even takes a tremendous amount of time, possibly, 2, you could reinvest that money into other stocks that have a greater return, so your cash is being utilized better. And 3, you have a potential avoidance of further downside risk. So that's why with every stock that we invest in, we put a stop loss in every security that we have.
And that's an interesting point, Michael, and I just want to focus on that a second. I think that the average investor, and you alluded to it briefly, buys at the wrong time and sells at the wrong time, but yet more important criteria here is that we tend to invest with emotion, and you tend to invest based purely on data. And I think that makes a difference.
I think there's 2 elements, Peter, and maybe I don't want to jump ahead, but one of the things that we also incorporate, and I don't want to jump ahead, but you brought something into the picture that I think is very relevant. Not only to believe in the fundamental process, but what helps us with our investment process is the technical aspect. And my partner, Kevin Lane, who has been on the show a couple of times, and I look to Kevin for entry points, for exit points, for relative momentum, and I look for Kevin more as I do the fundamentals, and I look for Kevin for the technical standpoint. And when we enter a name or we find a name that we've gone through the process of meeting with the company, doing our due diligence, having conversations with management, having conversations with the supply chain, et cetera, we are able to then speak with Kevin, and he looks at it from a technical standpoint. And that technical viewpoint can save basis points, and at the end of the day, that's very relevant as far as returns are concerned. And to go one step further in terms of your question or your thoughts, sometimes we get so emotional with things that it's hard to keep your discipline. And with a stop loss or a partner that, i.e. Kevin as our technical partner, we avoid that emotional response because at the end of the day, we're human. We're not computers. We do have emotional ties. We can say, oh, my gosh, I just spoke with a company, or they just had earnings. This company should be doing this. And our emotions do get involved with us, and they tie us to things, and they keep us at times much longer to a name than we should actually stay. One of the things that I've been really blessed with while I was at Ridgecrest Partners is my mentor in the actual buy side of the market said to me, they're pieces of paper, and you have to treat them that way. And because one sells a name today, that doesn't mean that you can't come back to that name at a later point and have a completely fresh viewpoint. So we try to take the emotions out of it. Clearly there are emotions because we're humans, but we do try to have some discipline from the standpoint of ourselves as well as when we buy things as well. So not only do we look at it 2 ways, we look at it from a stop loss perspective, but we also look at a stock. If we've made a gain on it, we also emotionally have to remove ourselves and look at it technically as well on how far has it gone, have we done our evaluation work on when to sell it, as well as taking the stop loss.
And that's interesting. We're going to take a quick break, Michael. When we get back, I want to focus a little bit more on the technical computer side of things and talk a little bit about the software you implement. But we'll be back in just a couple of minutes. You're listening to the In Black and Weitz radio program on the Voice America Business Network.
When it comes to business, you'll find the experts here. Voice America Business Network.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled Weitz. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
When it comes to business, you'll find the experts here. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled Weitz. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the show. We're joined today by Michael Needleman, the managing partner of the Fusion Long-Short Strategy. And prior to the break, we were talking about some of the pieces of criteria, some of the investment beliefs that Michael uses to decide what to buy, what to sell, and when. And he made an interesting comment. We were talking briefly about emotion. And he made an interesting comment about how literally a stock is nothing more than a piece of paper. And that's all it is. And to put anything more emotionally into it is not necessarily a strong conviction with regards to investing. And, I wanted to make sure that we stress that point because taking the emotion out is certainly what's made Michael successful. Moving on, though, one of the other things, Michael, that you focus on, and I happen to like this, and the cool thing about their strategy is that it's not driven by a certain style box, meaning we're not buying large cap growth companies, we're not buying mid cap value companies, we're buying companies that we feel have the best opportunity to make money. And typically that focus tends to be more on the small and mid cap stocks. But you made a comment, Michael, to me, and I think what's more important in this is that forget the market cap size of the stock. You're looking for companies that are more transformational in their current place in the market. And I'm wondering if you can comment on what that really means.
If you look at our overall mission statement, in addition to what Peter mentioned at the start as far as absolute returns, we talk about that we focus on companies that are undergoing transformations. And for us, when we think about that, when you look up Webster's and you look at the term transformation, the definition is it's the act or process of change in form or appearance. In companies that undergo transformations have, in our opinion, the opportunities for multiple legs of upside because you possibly can go through multiple legs of types of investing. You can go through a core GARP style investing with a transformational company. You can go to a growth style investor with a transformational company, and you can even go through to a momentum-style investor with a transformational company. And for what we look for when we think about transformations, companies can take transformations in many ways. It can happen when new managements occur. It can happen when companies make acquisitions or they make dispositions as far as assets. Standards can change, so that means that there's got to be multiple new products coming out. There can be regulatory changes. There can be demographic changes. There can be new products coming out. So what does all that mean? What we try to find are we look for companies that if we look at their model and they go through a transformation, what does that do to the end-up company as far as the look in terms of their margins, in terms of their cash flow, in terms of the multiple that that company may achieve if successfully goes through that transformation and where it currently is trading. And what we have found is if the company has a success at that transformation, we think that there's a great deal of upside to the names that we look at, because if they're successful in achievement of that transformation in terms of how they manage their business and the margins that they can achieve as well as the EBITDA and cash flows, then the market will start to recognize that. Wall Street has a habit of, once they start to smell things that are changing, the pace of that change happens much quicker than it used to. So now if people start to see a change taking place, that multiple move can happen much quicker than it used to. So because of the advent of technology, because of the advent of what people are watching, because of the advent of how people are looking at the technicals now much more than they used to in previous times. So what we focus in on are companies that we believe can achieve those transformations and what we think Wall Street will start to pay for that transformation versus where it's currently trading.
It's very, very important as we talk about companies that you want to buy. But now it's switching gears. You've got all these investment beliefs, right? And you've got a mission statement and so forth. And I think now what's important is, there's still a ton of stocks that are out there that you have to figure out which ones you want to buy. And I mean, again, you bring in this human side of it. There's only so many you can evaluate on a given basis. And I think what's been amazing is that you and Kevin have been able to put together this software, this proprietary software we call Fusion IQ. And I'm wondering if you can touch on what it does and why it's such an effective tool for you.
Fusion IQ is a proprietary-based product that Kevin has been very instrumental in putting together, and actually is almost like his child because he's worked on it for years. And what Fusion does is ranks stocks in certain criteria and certain things taking place on a technical basis, whether or not it's volume, whether or not it's price action, whether or not it's earnings, whether or not it's momentum, a number of different technical indicators, and it ranks those individually every night. What we look at in the IQ system is for buys is anything above a certain area. Having said that, because we're finding companies that are undergoing transformations, some, not all, but some of the stocks may not be buy-rated or ranked yet. What's just as important as finding those names that are ranked positively are names that we think that there's a great deal of support when we enter the stock. So what we try to find are names that if it's not a buy-ranked stock, Kevin will look at that stock technically and say, here's your support, so we know our downside. And in that process of Wall Street becoming or sensing that this company may be going through that transformation, if we have a very comfortable downside protection and we start to get that action of better numbers, whether it's top line, whether it's margins, whether it's earnings start to drop better than Wall Street expects, and then the stock will move, eventually getting a higher rank. That's just as important as our ranking system, at least for us, the way that we put this process together. It's really worked because not every stock that we look at that's undergoing transformation will be ranked to buy in our system. And some people just buy the IQ-rated buy stocks. And by the way, we've done a great deal of back testing on that, and that's shown that if you buy certain stocks that show buy in our system, your returns have been very good. We look for companies, as I said, that go through transformations. Therefore, some of the stocks aren't going to be buy-rated, but we do look at the technical element on where the stop should be, and we have that in our system. So that also helps from the standpoint of when or what companies we should look for as far as our investment process.
Thank you for that. And we're going to take a quick break. When we get back, I want to get deeper into the investment process and sort of your tactics to determine returns in equities. You're listening to the In Black and Weitz radio program on Voice America Business.
From the boardroom to you, Voice America Business Network.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Voice America Business Network, the bottom line in business.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the show. I'm your host, Peter Weitz. We're joined today by Michael Needleman, the managing partner at Fusion IQ and the managing portfolio manager of their long-short strategy. And prior to the last break, Michael's been going through his investment philosophy and how he decides on what to buy and what to sell. And I want to focus a little bit now on some of what happens inside of stock selection and ultimately what goes inside of the portfolio that he picks. And it's interesting because and I'm just going to make a quick aside, Michael, but I follow this strategy quite often. And we have several clients that have been happily invested inside of it. And I can tell you that it's so complex and so sophisticated as to what they do that the vast majority of the companies that they decide to purchase, I've never heard of. And I think that's pretty cool because you're not just buying the IBMs and the GEs of the world. You're actually doing significant research into firms that have this transitional upside, as you call it, and yet we don't even know what the companies are. And I appreciate that. But as we talk about equity return tactics, Michael spelled out 3 philosophies, and I'm going to have him comment on each one. But they've actually, written a little blurb about what they mean into something that is extremely useful for us as the average Joe investor. And the first is market return or market direction. So market direction is an equity return tactic. And what they mean by that is over the course of history, when the overall market generates positive returns, so do more stocks. Hence the saying, a rising tide lifts all boats. And so I'm wondering if you can comment on market direction.
What we focus there is, and this is not, I don't want to say rocket science by any measure. That said, when the market is trending up, the tide rises for a lot of stocks or the mini stocks, and you want to take advantage of that. That's when one wants to be more fully invested and push the pedal down. Because when you have a positive market direction at your back, or as I refer to it as a tailwind, that is a major part of overall returns. That said, because we have the ability to be tactical, we have the opportunity, if in fact we start to see things from a technical standpoint being overbought, or we start to see unfortunate news to take place that has constantly been bombarding the newspapers, we are able to change our tactics 2 ways. One, we can raise cash. And by the way, there's nothing wrong with raising cash. 2, we can go short certain securities. And that's what we refer to as a tactical nature. Maybe the market gets tired. Or for instance, when this past year, when we saw the market really start to hit all the momentum stocks, all the growth stocks, and a number of other stocks as far as small cap stocks, we went short the market. And we had short exposure up. Our long exposure came down, and we additionally raised cash because of the uncertainty of the marketplace. But when the market is heading higher and the overall direction of the market is heading higher, we want to be more exposed, and we truly want to take advantage of that tide that's taking place.
And then, so now the second part of that is sector in the market. And, you comment that by saying the old saying goes, you can tell a lot about someone by the company they keep, and buying stocks is certainly no different. And so when you look at a stock, do you look at what's going on in the sector?
You have to. The answer is absolutely, Peter. You can't, I shouldn't say you can't. One, or at least we try to have an understanding of how that sector is performing, how that psychology on that group is being played out currently. Now, that doesn't suggest that psychology can't change, but if there is a better sentiment in a certain group, and we find a name in that group that may be going through a transformation, we may more likely be more positively disposed from the standpoint that the backdrop is positive, the industry's seeing good fundamentals, they're able to see pricing, et cetera, we may look at it. That's not to say that we haven't picked a name that's in a sector that's coming under pressure, but the majority of times we try to find names that are positively disposed as far as sectors are concerned. Because one can pick a stock for a number of different reasons and the stock not work. And you could be absolutely right with your fundamental aspect, but because of the sector, because of the psychology of the marketplace right now on that group, whether or not it be small caps that we just went through, whether or not it be industrial names or biotech or whatever it might be, it's a harder road to kind of go up against.
And as a follow-on question to that, if you look at the small cap sector, particularly the last 18 to 24 months, it's produced tremendous upside. Why does a sector fall out of favor? I mean, what drives that?
It can be a number of things. In terms of small caps, I think it's that the sector has outperformed for not just the last 18 months, but it's actually outperformed almost for the last decade. And there comes a time where there's got to be somewhat was referred to as a reversion back to the mean. And that may mean that, larger stocks or different stocks in small caps perform better. So what did occur and what has happened is in small caps that did go through a correction. And by the way, a correction is 10%. The Russell was down almost, it did hit 10% intraday. So that was a full-blown correction. And people always say, well, the market hasn't corrected. There are certain sectors of the market that have gone through a correction. Not only a correction, but a bear correction. And a bear correction, by the way, is 20%. So there were growth stocks that just got pummeled. There were biotech names that were down over 20% during that time period. So what happens and what has happened since that time is twofold. One, the value side of the small caps have started to really outperform. That's the first thing. And the second thing is there's finally been some type of support back into the growth names, and many of those growth names that were down 50, 60% have had fairly large bounce backs in the last, call it, 8 weeks. So they haven't come back to their past valuations, but they've definitely well come off the bottom. So many things can happen because of group falling out of favor, whether or not it's the multiple, whether or not it's just perception, whether or not it's just the environment, and things starting to slow. So although small caps and mid caps, and by the way, we're still of the belief that in those sectors, small and mid cap, one can achieve greater returns because many of the stocks are not known. Many of the stocks are not followed by Wall Street. And there's much more of an opportunity, in our opinion, for things to go if things do go positively for upside returns.
And so, regardless of if the sector corrects or not, I mean, you still think that there are opportunities in the small cap market today?
Absolutely. And we literally have we made a post because we, like you, have contribute to the Fusion market site post, but we have a name that we are still extremely bullish on, and it's when we wrote about the stock, it was $4, and now it's $5.41. So we think there's a tremendous amount of upside in this stock on a continuing basis. So there's a lot of names that we think can outperform the market and are still very comfortable given the parameters of their market cap. That said, over the last, call it 3 months, we have gone more mid-cap as far as our structure and the size is concerned. We've done that for liquidity purposes because when the market gets rocky the way that it was and liquidity dries up, we needed to focus and look for names with larger market caps, not multi-caps or mega-caps, but larger caps as far as the mid-cap. So we've gone a little bit more mid-cap than small-cap, but we continue to be positive on the small and mid-cap areas.
And do this for me. Define for me in terms of capitalization value the distinction between small and mid-cap.
Peter, that's a question that if you ask 15 managers,
I'm going to get a different answer.
15 different answers. For us, small cap is anything under, let's say, $1.5 billion. Mid cap can go all the way up to, say, almost, call it $20 billion, depending upon the market size, depending how you kind of look at it. Again, but you can talk to multiple managers and they'd give you different things. We have a number of companies that are under $500 million in market cap, and we're not opposed to those names. And we have found over a period of time that that's where we've made a substantial returns in the smaller market caps over a longer period of time, but we are a little bit more comfortable with a larger market cap, a little bit more liquidity here recently.
Yeah, and that's it. I agree with you that there's definitely no right or wrong answer. I was more interested, and I probably should have asked you, how do you evaluate what's small and mid? But from listening to your strategy, does it really matter what their capitalization is in the market for your purposes?
No. As a matter of fact, it doesn't. We focus on small to mid-cap names, but we've also do have a couple of larger cap stocks in our portfolio. So we are looking for names and companies that are undergoing transformations, and there are many stocks in larger cap stocks that are going through transformations. We have found a little bit more success with small to mid cap, but we do know of names in the larger cap that are undergoing transformations as well.
Yeah, and I'm gonna take a quick break, Michael. And when I get back, I want to do a couple of things. I want to hear where you guys are positioned currently in your portfolio in terms of long, short, and cash, and then maybe go through a couple of case studies to just show how the whole process really works.
Absolutely.
Okay, and I thank you for that. And you're listening to the In Black and Weitz radio program on Voice America Business.
Voice America Business Network, the bottom line in business.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
The business community's first choice in Internet Talk Radio. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
You know, during the break, we were talking about just travel and so forth. And I think it makes an interesting point is that, you know, when the perception of what goes on in the market, Michael, is not really the reality. And we made an interesting point. Brad, my sound engineer, is in Phoenix. And, you know, when people say it's 115 degrees and they talk about it being a dry heat, well, it's still 115 degrees. So regardless of humidity, it's still hot. But the perception is that it's not as hot because there's no humidity, and that doesn't make any sense. Well, I kind of just thought about that, and I think it really equates to sort of this whole theory that you have, Michael, is just that you really need to take out what your perception is and what you think and get really down into what really works, and that's the numbers. And so I kind of want to hear more about where you are in the market at the moment. How heavily invested are you?
We, Peter, in February and March, we were, let me go back, in October of last year, we became very aggressive in the marketplace. And we took off our short side of the equation and basically almost became fully invested. And that's what I referenced earlier, is that we have that ability to become tactical. And we were fortunate enough to catch that move in the marketplace. And when we started to see the market pull down, we reversed course quickly. And we reduced our exposure. We raised cash, and we also were, in March, we were almost 22% short. And what we did is reallocate those assets. And we also had a cash position of almost 20-some-odd%. So we were, at that time, we were one of the lowest portions of our investment cycle since I've been here, since 2012. And we reversed that and actually have become more exposed to the marketplace. And currently, we, at the present time, are about 70% invested, which is on the higher side of things. We currently don't have exposure to the short side. But, and I say that but, over the last week and a half, especially, or 2 weeks, especially with the news that's taking place, we've taken a little bit off the table as far as our long positions and are somewhat watching how the marketplace works its way through this recent geopolitical process that we're kind of undergoing. There's many thoughts as far as what can happen in the Middle East. I'm not a political expert by any means, but the thing that is kind of almost 100% agreed on is from the oil flow, that the oil flow has not been affected from where the issues are occurring in Iraq, so that they should be able to flow that oil. But oil itself has gone up, and that's a big kind of denominator as far as how the market's viewed, because that's an inflationary scare, and it also affects other things. So in a long-winded way, we've become a little bit more cautious on our names, but we are still about 70% invested.
Yeah, that speaks to how you still believe there's a lot of room left in this market.
Absolutely. And on top of that, one of the things that we've kind of balanced ourselves out with is we've kind of have exposure in a number of different areas. We're generalists, so that allows us a lot of flexibility on the areas. We have industrial names, we have technology names, we have some retail names, we have some stocks that we believe are still going through a transformation that offer a high dividend return. So we have exposure. We have oil names and exposure to the oil markets. So we've got exposure in a number of different verticals, and we're not just focused on technology or retail or industrial names. We're somewhat overall balanced to our approach. We don't have a balanced weighting to any group, but we do have flexibility as far as the names are concerned.
Yeah, and the retail piece is interesting because, when I look at when I looked at one particular retail holding in your portfolio, my first inclination to say, I can't believe that they would own that company, just because of, again, my perception. And, these things are just amazing because what I would think I would never take a look at as a stock that I would want to own has just gone up in value.
We're fortunate, and hopefully, I hope that you're speaking of an amusement park of all things, but we've been investors on and off in the amusement park area, and from the standpoint of how that is going through a transformation, we first invested in the stock, and it's Cedar Fair, and the symbol is FUN. And we first entered the stock when the stock was $22, and we actually rode it almost for a year and a half, and it went up to $45. But not only did you get the return of that, but more important, there was a very good dividend. And we actually recently have come back and re-engaged in the stock, and when we re-engaged in the stock, it had over a 5.5% dividend, and we felt that we were just coming into the seasonal standpoint. They've had 2 years of record attendance, and we think that there's going to be another record attendance. They're getting pricing. There is no longer market share being kind of looked at in terms of giving discounts at the parks. They've also put in a number of new hotels and convenience to have monetization outside of the parks. They've increased their food. They've done accelerated passes from the standpoint of rides. So we've been very successful in that name, and we still think that there's a great deal of upside. And if you go back and take a look on top of what I've said as far as management, the transformations, one other thing that's occurred is there have been new managements in all of the companies that are public in that sector here. There's Six Flags, and there's also SeaWorld, as well as Disney, but Disney has a great deal of other operations in terms of just amusement parks. The other two names that are there, they're running it for real returns, and that's where we think the transformation is taking place.
Yeah, and that's what's amazing is that you would never really think to own an amusement park as a stock, but yet here it's, just gone up in value. You've sold it at a high point, and presumably when you bought it back, it had made a dip down where you still see more upside value.
That is correct. That is absolutely correct. We re-engaged about 2.5 months ago.
Yeah, and so, and one other quick case study, and then unfortunately we're going to have to end our conversation for the day. But, I just give you a name to throw out there as a case study, and just to give you an idea of the types of companies they buy. Value Vision Media. Now, I don't know anything about the name. I don't know what the company does. Obviously, with the name media would suggest that they're in that industry. But here's a company that just came out of nowhere.
And Peter, this is a case study that I think is important as well. It's easy to be able to talk about the names that you find success in. One of the things that Value Vision is a stock that we held in our overall process, and we actually sold the stock because it hit what we felt was our stop loss. Value Vision is what I would call the number 3 player in home shopping. And what we looked at was we looked at a management team that was starting to show true comps. And by the way, when you hear the term comps in retail, it's sales that a company reports versus a period a year ago. And what we started to see was comps were accelerating, and we thought that we could see upside appreciation. We also felt that there was a board opportunity because there was a very large shareholder that was disappointed with the management team, and we felt that there could be a management shakeup. And we were right with the fundamental standpoint because their sales have accelerated, the engagements have gone up, but the stock didn't perform. And that's why you have to be somewhat disciplined in the stop loss. We did buy the stock, and we were fortunate enough to sell the stock at a small profit, but we weren't really seeing what we needed to go. And this is not that we weren't successful. We were successful with our process. We were successful with what we thought could happen, and it just didn't happen in terms of the stock return is concerned. So we look at a number of different areas and verticals, and we try to adhere to the process that we've implemented as far as our overall investment process as far as the strategy. And that's what we've had to do with the case study with Value Vision.
Great, and I appreciate that. And more importantly, Michael, I really appreciate you being on today's program.
Thank you so much, Peter. And if we can help at all, please give Peter a call, and we'll be more than happy to speak with anyone from the standpoint of any questions that they might have on our strategy.
Yeah, and I appreciate that. Next week, we're going to change gears a little bit, and we're going to talk about data protection, because that seems to be a pretty big thing going on in the world right now, and Papa John's and Target and some others have been into some problems. And so we're going to give you some tools and tips on how to better protect your data. Again, thanks to Michael Needleman, managing partner from Fusion, talking about his long-short strategy. Great conversation. It'll be available on the iTunes library at some point later on today. Again, make it a great week. You've been listening to the In Black and Weitz radio program. I'm your host, Peter Weitz. Thanks for listening.
Thank you again for tuning in to In Black and Weitz. Please join your host, Peter Weitz, again next Tuesday at 10 a.m. Eastern Time and 7 a.m. Pacific Time for another edition of the program on the Voice America Business Channel. Have a safe week.